Hello. So now we're going to focus on how do we allocate indirect costs. So remember that indirect costs, such as indirect labor, is part of the overhead costs to be assigned to your product cost. Okay? Let's assume that our indirect labor total was $120, and that was for 8 hours. Therefore, the allocation rate would be $15 per hour. So now here we have two different products, a chair and a table. Let's assume it takes 2 hours to make the table and 2 hours to make the chair, but 6 hours to make the table. So we're going to assign $30 of overhead costs to each chair and $90 of overhead costs per table. So we're going to assign, this is known as the cost allocation, where we're going to assign the indirect cost based upon an allocation rate. The allocation rate is going to be $15 per labor hour. Okay? So remember that your product cost consists of three components: direct material, direct labor, and manufacturing overhead. So relevant information about these three cost components is summarized over our next two slides. So we can begin with our direct material, which is your raw material. So the raw material will be in addition to anything such as wood or material. It could also include manufactured parts such as engines, glass, car tires, etc. Any material needed to make the actual final product. Your direct labor costs will consist of the cost of wages paid to factory workers involved in hands-on contact with the products being manufactured. All right, so we take the amount of time worked by these employees times their rate of pay to get your direct labor costs. Then your manufacturing overhead will consist of a variety of items such as any cost taking place within the manufacturing plant that's not direct material, direct labor. So things such as indirect materials. You got your glue, nails, paper, oil, etc. Indirect labor such as the production supervisors, inspectors, maintenance personnel, those employees who work at the factory but don't work on the actual product. It could be rental costs for the manufacturing facility or equipment, utility costs, depreciation, security, the cost of preparing the equipment, maintenance costs on the equipment. What we end up doing is we determine we're going to assign overhead costs typically based upon some type of overhead cost rate. Okay? So now we're going to talk about upstream, midstream, and downstream costs and manufacturing for both a service-based company and a merchandising company. So midstream costs are composed of the costs incurred to process of making products. That would include direct material, direct labor, and your manufacturing overhead. So when you hear someone mention mainstream costs, they're referring to their product costs. Upstream costs are incurred prior to the manufacturing process, including research and development costs and product design. So before we start to actually manufacture, say, those tables have to be designed. We may do some research to make sure we're designing a stable table. We want to make sure that the design is pleasant on the eyes, things of nature. Those are known as your upstream costs. Your downstream costs are costs incurred after you complete the manufacturing process. That will include in marketing, distribution, and your customer service. So midstream costs are your product costs. Your upstream costs are the costs that take place prior to, such as research and development, product design. Downstream costs take place after manufacturing. This is your marketing costs, distribution costs, and your customer service costs. So this example shows the upstream cost for a company, your midstream cost, which again would be your product cost, and your downstream cost, which are the costs taking place after manufacturing, such as marketing your product, distribution of your product, and your customer service. Okay? We'll now look at a gap based income statement. So, this is the income statement based upon generally accepted accounting principle. So, you begin with your sales revenue minus your cost of goods sold. That's your midstream cost, i.e., your product cost. That gives you your gross margin. So, sales revenue minus cost of goods sold equals gross margin. Next, you have your operating expenses known as general, selling, and administrative costs. Here where you have your upstream and downstream costs. It could be research and development. It could be advertising. It could be your marketing, customer service. Those go up under your general selling and admin costs. Subtract those from your gross margin to compute your net income. Okay? So now let's look at a service organization. So for a service organization, we're not going to have a physical product rather than we're providing an actual service. So for a service-based organization, your product cost typically will consist of just labor as well as overhead because there may not be any direct material for your service costs. But let's say that we're providing oil services. So the oil would be part of your overhead costs because that would be more of an indirect material cost. Merchandising business, or sometimes called retail. So companies such as Walmart would be a retail or merchandising business. If you're a wholesale company, typically means that you're actually making the products. So companies like General Motors, Ford would be considered a wholesale company. They sell goods to other companies. So manufacturing companies make the goods that are sold to their customers. Okay. So when you have a service and merchandising company, they're going to incur material costs, labor, as well as overhead. The main difference is that for a service-based company, your finished product will be the actual service provided by that company. So if you are an accounting firm, you're providing an actual tax service, then the tax service will be considered your finished product. Okay? Merchandising companies frequently hold inventory. They differ from manufacturing companies in that they do not make the product they sell. So a lot of your merchandising companies, say such as a Nordstrom, they do not actually make products. They buy them from the manufacturing companies, whether it's Ralph Lauren, Hugo Boss, etc. Okay? Next up, we have what's known as a schedule of cost of goods manufactured and sold. So we're looking at what costs should be included when we produce an actual product to compute our schedule of cost of goods manufactured and cost of goods sold. If you are a manufacturing company, meaning you're making a product, you're going to have three different distinct inventory accounts. Raw material, which includes the products in a unfinished state. That could be the lumber, the metal, the paint, the steels. Those direct materials are going to be your raw material. Work in process is when you're adding labor to the raw material to work on completing a product. However, and it's in the work in process stage, it means the product is partially completed. So, envision a car going down the assembly line. So as they're adding material to that car, it's in the work in process stage. Now, once the product is completed and ready for sale, it is now in what we call the finished goods inventory. So for a manufacturing company, three inventories: raw materials, work in process, and your finished goods inventory. So this exhibit is showing the raw materials. Then you move to work in process, then finished goods. And once the product is sold, you recognize your cost of goods sold. So you got the cost of material available for use. You can look at the material used for your labor, your overhead. So again, these three make up your product cost. Let's do this. Let's take a look at an actual example where this diagram will make more sense. And basically what we're going to do is show you how to calculate your cost of goods manufactured as well as your cost of goods sold. So let's get to an actual problem with some numbers to compute our cost of goods manufactured and our cost of goods sold. So you might need to pause, do a screenshot, take a picture of these numbers. We're going to use these numbers to produce what's known as a schedule of cost of goods sold. So these are our costs. We purchased raw materials for $37,950. We use raw materials at a value of $37,000. We incurred $34,600 of labor costs, $26,700 of overhead costs. Completed work on a product that cost $94,600. Again, $94,600. And we'll talk about how we came to that dollar amount. The beginning balance for the year for finished goods is $2,000. Okay? So again, if you need to take a picture of these different line items so we can prepare our schedule of cost of goods manufactured. Also during year two, we had sales revenue of $153,000. Then at the end of year two, we had these balances in our inventory account. Raw materials inventory balance was $950. Work in process inventory balance $3,700. Finished goods inventory balance $3,200. So once again, write down these numbers or pause the video to get this information, but we need to prepare what's called your schedule of cost of goods manufactured. Okay, so let's take a look at our schedule of cost of goods manufactured. All right, our beginning raw material inventory was 0. We had purchase of the year of $37,950. At the end of the year, that amount was $950. Therefore, 37,000 material was used. That represents your direct material cost. Add to that your labor cost, 34,600, overhead cost, 26,700. So your total manufacturing cost was $98,300. You're going to add to the manufacturing cost your beginning work in process inventory. For this example, that amount was 0. So our total work in process inventory was $98,300. That was the total cost of all of the items that we were working on throughout the course of the year. Subtract out your ending work in process inventory to compute your cost of goods manufactured. So work in process was $98,300. At the end is $3,700. The difference of $94,600 represents your cost of goods manufactured. So it's the total cost of the goods that we manufactured during year two. You okay with that? We're going to add to that our beginning finished goods inventory. This is what you had available at the beginning of the year. That amount totaled $2,000. So our total cost of goods available for sale was $96,600. So this is the total cost of our inventory at the end of the year. Throughout the year was $96,600. Subtract from that your ending finished goods inventory at $3,200 to compute your cost of goods sold for $93,400. Okay, that was a lot, right? Let's let that marinate for a while. We're going to come back and conclude our discussion on chapter 10. Okay, bye-bye.